Hey, welcome to the exchanges. If you don't take a look at Vroom Automotive, ticker symbol is VRM. They're basically a used car seller, kind of same realm as like Carvana, CarMax, Shift Automotive. They're all kind of competitors in that competitor bucket right there. The stock is absolutely just bled down from the mid 60s or so, and it looks like here August 2020 timeframe down to $1.43 as of July 6th. So let's explain why it's actually crashed so much so hard, also where it could go in the future too. So this is the model of Vroom Automotive. So we'll start on the revenue line first. So say in 2019, roughly $1.2 billion. It grew to roughly $3.2 billion in 2021. I actually had the revenue growth percentage actually down here. So you see 2021, I mean, absolutely standout year. And this is why the stock shot up so much in that time period, but it's slowing down now. So you see in 2022, market's projecting roughly a negative 22% revenue growth rate, which obviously is pretty bad, but again, it could be much, much worse if we enter a recession. Look at 2023, it will recover, saying 8%, but even the long-term growth rate is not going to be the hyper growth we had in 2021. That's really why the stock has crashed down so much in these past few months. But looking at overall gross profit, I mean, the gross profit is very positive, which is good, but I mean, profit margins themselves are just not very high for a used car dealer. I mean, you're seeing here roughly 5%, 6%. This will increase in 2022 because they just acquired basically a loan servicing company, UICC, which should basically add extra profit margin on top of their actual gross profit percentage, though. But it's not going to be a massive increase, at least not at first, but we'll see how it shakes out, though. But hey, I'm saying long-term profit margins, roughly, 8, 9, 10%, somewhere in there looking forward. So looking at operating expense here, the really big one is they combine an all-in big bucket is sales and general administrative. Don't look at the actual numbers down here. Look at the actual percent of revenue. So you see in 2019 to 2021, roughly a 16 to 18% kind of range in there. This will jump up massively in 2022. It's already basically priced in the stock right now, which is why the stock has crashed down so much. So basically when the revenue drops off, but expenses stay roughly the same kind of ballpark, you see a massive uptick as percent of revenue. Basically you're seeing right here 29%, which is, this is pretty bad. And this is why the stock has crashed down pretty far. Now this will recover, I'm saying in 2023, but again, you have slowing revenue growth rate. So that means, hey, this OpEx expense has to drop down. I mean, this might be layoffs, slowing expansion, really getting more regionalized across the country. I mean, this number has to come down. If we see a long-term, high 20% range as a percent of revenue for SG&A expenses, I mean, it's going to be very nasty for Vroom overall. So let's move to the next line down here. So it's operating income, but really look at operating margin down here. So you're seeing, I mean, they've always been negative, basically losing money year over year. So you're seeing roughly around, negative 11, negative 13%. I mean, 2022 is going to be a rough year. I mean, we already know that, and that's why it's already priced in the stock. It looks like margin right here, negative 21% on an operating basis. This will get better, but really the long-term path of profitability is not quite defined yet. Wall Street doesn't see that overall. So if you look at actual net income, the very bottom line down here, I mean, you're seeing 2022. I'm saying this year they lose $500 million, and I'm saying next year, 2023, they lose $400 million. But it's all these numbers down here, these are all negative. I mean, the company as a whole has no path of profitability as of this moment. Now, things could change in the future, but as of right now, Wall Street's really valuing this as, hey, future cash flows are all going to be negative. So how do you value that? What's the value of losing money in the future? And the answer for that is probably zero. Now, the stock could recover. I mean, they could have corporate shifts, more regionalized kind of structure across Vroom, could have better data AI models, et cetera, for better, price placements and price optimizations, et cetera. But again, as of right now, the path of profitability is just not well defined. And once they have one, the stock could recover quite a bit. But as of right now, at least the numbers wise, it just doesn't make sense as a business model itself. So I also want to point out this bottom area down here. So this is cars sold and net loss per car. This is some math I did. This is looking at 2019 through 2022. 2022 is an estimate actually, so it's not finalized numbers there. I mean, you're seeing, hey, year over year, units sold is increasing basically exponentially, which again, that's very good. But net loss per car is pretty bad overall. So how I got that is taking an income number right here is 142,000 of 2019 divided by this 18.9 thousand. You basically get this number right here. Do that same math across every single year. You see year over year, the actual scale itself is not quite helping them overall. So they're losing roughly about, again, 5K per car, roughly, year over year. And this trend, I mean, this cannot continue for long. This has to flip around. It has to change at some point. Because otherwise, I mean, they're going to run out of cash at some point. So speaking of cash, I actually added the slide in from their Excel sheet, or on the Excel sheet. It's actually from their investor presentation back in May. This is actually the forecasted year-end liquidity, basically cash available on the balance sheet to actually fund operations itself. So they're starting off in, as of 3/31/2022, last March, $601 million in cash. They're saying roughly this year on adjusted EBITDA basis, they're going to burn about $250 million in cash from second quarter this year to basically year end in December. They also have a CapEx expenditure, which CapEx is just capital expenditures, basically cash outside their operating cycle that gets basically burned in basically future investments. Now, some of this stuff is non-cash based, so like stock-based comp, use UACC financing, restricted cash, basically releasing. Basically, that cash is basically available to use again for whatever purposes. Also some other buckets here too. But again, the actual cash burn, actual liquidity burn itself is not that bad overall. I mean, they're going to end this year roughly at roughly around $500 million of liquidity itself. So if I had to guess, I mean, I would say at least this company has at least 18 months to 24 months of basic liquidity left before they hit a major kind of credit crunch overall too. Which, if they're lucky, hopefully they'll be backside of a recession. So hopefully 24 months from now they're raising cash or raising equity or debt, or whatever it might be, in a kind of a more healthy environment overall too. So right now, I mean, raising debt and it's a bear market, kind of recessionary fears, etc. It's gonna be very, very expensive in the long term. Hey, so that's really all the bad news, and really at the stock price we're at right now, which is about $1.40 or so, you're basically pricing in bankruptcy. It's either investing in it today, either option A, they go bankrupt, or option B, they don't. And really, if they don't go bankrupt in the near future, I mean, this stock will go up naturally because it's been so much bad news priced in this past few months where it's got nowhere else to go, but either bankruptcy is zero or potentially much higher than it's at right now. So next I want to add to, this is a very small company. I think the current market cap is roughly $200 million. So it is a very, very small company. I checked last, the percent of float that was short was 31%. So that's a massive percentage of the float that is short itself. So this is very squeezable just because it's a very small company, high short float overall, pretty liquid overall too. So it trades pretty healthily across the market. And this is one of those things where, hey, any kind of catalyst, any kind of bullish news, I mean, this thing could absolutely skyrocket well past where it's at right now, just because right now the market cap is so low compared to other companies out there. So last point to add real fast, there's also a good chance this company, if it goes below $1 or even near right at $1, is a chance of a reverse split, which all a reverse split is basically dropping your shares outstanding and dropping it down. So for example, if you have 10 shares of Vroom, you basically turn those 10 shares in, you receive 1 share in return. With that 1 share in return you receive is 10x the share price itself. So economic value wise, the company is worth the exact same amount as it was before, pre-reverse split. But like psychologically wise, I mean, that share price being 10x, I mean, it does wonders to share prices and help, potentially have that basically follow forward gains of having a higher price, even though the actual value of the company itself is worth the exact same amount. Hey, but that's Vroom overall. I mean, drop a comment down below if you're a buyer at these prices or if you're going to bag hold through this recessionary dip we're having right now too. Also, I might do a part 2 of this video. There's actually the investor report. It's actually very, very detailed. I think it's very, very interesting. So I might do a part 2 video on that report by itself, the kind of more detailed analysis overall too. Also, be sure to tap the like button as well. But also, if you want to see updated content on Vroom, I'm doing a video on them probably post Q2 earnings release, which should be in the August time frame. But yeah, be sure to sub down below for that updated content. Yeah, until next time, that's the exchange.